Hey everybody, it's Nick from Sure Dividend here, and in today's video we're going to be talking about how investors can learn from Jeff Bezos' long-term thinking. And for me personally, this video is super exciting because I think Jeff Bezos is a remarkable CEO, and I think that investors really do have a lot to learn from how he thinks for the long term. So before we dig into the material, I'll just invite you to subscribe to our channel and like this video if you've enjoyed it so far. So to begin with, who is Jeff Bezos? He is the founder and chief executive officer of Amazon.com, which is a $700 billion technology company that's known for dominating the e-commerce landscape as well as providing cloud computing to thousands of corporations across the country. Now, Amazon is not a dividend stock, so it's very different from a lot of the companies we cover at Sure Dividend. With that said, Jeff Bezos' unique leadership style means that investors still have a lot to learn from the way he runs his company. Now, what really stands out about him, and the title of this video makes this very unsurprising, but what really stands out about Jeff Bezos is his ability to really think for the long term. And you can see this going back to the beginning of Amazon in 1997, where he wrote in his inaugural letter to shareholders, "We believe that a fundamental measure of our success will be the shareholder value we create over the long term. This value will be a direct result of our ability to extend and solidify our current market leadership position. The stronger our market leadership, the more powerful our economic model. Market leadership can translate directly to higher revenue, higher profitability, greater capital velocity, and correspondingly stronger returns on invested capital." Now, it's kind of ironic that Jeff Bezos' long-term thinking has been around for the long run. And the way that we're going to approach studying this throughout this video is that we're going to explore quotes of Jeff Bezos piece by piece with respect to how they relate to his long-term thinking, and then generalize those principles to explain how a self-directed investor can implement them when it comes to portfolio management, stock selection, and overall due diligence. The first lesson that we'll talk about is to be disinterested in quarterly results. Now, Bezos has a really great quote about this, but it comes from a video, not from writing. So the easiest way for you to understand this is for me to just paste the video right now. So hang on and I'll show you the clip.
But when somebody says to me, congratulates Amazon on a good quarter, which is a very common thing to say. You meet somebody, they're being nice, they looked at your financial results for the quarter, they're like, good quarter. I say thank you. But what I'm thinking to myself is that quarter, those quarterly results were actually pretty much fully baked about 3 years ago. And so like today, I'm working on a quarter that is going to happen in 2020, not next quarter. Next quarter, for all practical purposes, is done already, and it's probably been done for a couple of years. And so if you start to think that way, it changes how you spend your time, how you plan, where you put your energy, and your ability to look around corners gets better. So many things improve if you can take a long term. By the way, it's not natural for humans. So it's a discipline that you have to build. The kind of, get rich slowly schemes are not big sellers on infomercials. And so that's something that you have to sort of steel yourself for and discipline and teach over time. So that's what is Amazon. I would say really it's a collection of principles and it's an approach that we deploy, and it's fun. I dance into work.
As you can see, Bezos cares very little about the quarterly fluctuations in his business's performance. And that's because those results are really baked in a long time ago. He prefers very much to think about what's happening in the future and what he can do today to ensure the success of Amazon years from now. Now, for investors, I think the way to generalize that principle to portfolio management is to not be so focused on what a business does in an individual quarter, but instead to be cognizant of what its long-term growth trends are, and to be understanding of whether its competitive advantages are still intact and whether it's likely to deliver much higher earnings, say 10 years from now, not 2 quarters from now. The next lesson we'll learn from Jeff Bezos is to be willing to make investments that may not pay off for several years. Here's what Bezos says about this. "If we needed to see meaningful financial results in 2 to 3 years, some of the most meaningful things we've done would never have even started. Things like Kindle, things like Amazon Web Services, and Amazon Prime. The list of such things is long at Amazon." Now, for investors, we don't really make investments in products like Amazon Kindle or in new platforms like Amazon Web Services. We make investments in new stocks. And the way to generalize this principle to stock investment is to say, I'm willing to invest in stocks that might not appreciate for several years because I'm recognizing that they're trading below their intrinsic value right now. And even though I might be early, I know that I'm still right. The next lesson we'll talk about is to find companies that align the interests of customers with the interest of shareholders. In the early days of Amazon, Jeff Bezos drew very harsh criticism for allowing negative product reviews on the company's websites. He wrote this about an analyst. One wrote to me and said, "You don't understand your business. You make money when you sell things. Why do you allow these negative customer reviews?" And when I read that letter, I thought, we don't make money when we sell things. We make money when we help customers make purchase decisions. In the long run, this paid off because today consumers recognize that the reviews that are everywhere on Amazon.com are one of the key differentiators between it and other comparable services. Bezos had the foresight to see that these customer reviews align the interests of customers with those with shareholders, because it meant that when customers succeeded, so did the business. Buying products that were actually good led to higher customer satisfaction, more loyalty, and less money spent negotiating and administering refunds. Now, that's a winning strategy for the long run, even though allowing customer reviews generated short-term criticism from analysts. Bezos says this about being long-term oriented with respect to customer satisfaction. If you are long-term oriented, customer interests and shareholder interests are aligned. In the short term, that's not always correct. Now, for shareholders, investors in common stocks, we need to find companies who exhibit these characteristics. We don't actually run companies ourselves for the most part, so we need to find these philosophies in the companies that we invest in. The fourth lesson is to create recurring revenue streams that grow over time. Here's what Bezos has to say about this. Well, our approach to our hardware Kindle devices, Kindle Fire, and our Kindle readers is to sell the hardware at near break even, and then we have an ongoing relationship with the customer where they buy content from us, digital books, music, movies, TV shows, games, and apps. And the reason that we like that approach is because we don't make $100 every time we sell a Kindle Fire HD, since it's near break even. Instead of making a bunch of money, then, we're happy if people keep using our products. We don't have to have you on the upgrade treadmill. As you can see from this quote, Bezos prefers long-term recurring revenue streams. And for investors, the obvious analogy here is to invest in stocks that are paying dividends now and highly likely to pay consistently rising dividends over time. Our favorite database of stocks like that are the Dividend Aristocrats, which are stocks with 25 consecutive years of dividend increases. I'm going to put a link to our Dividend Aristocrats database in the description of this video so that you can access it easily when you're done watching. The fifth lesson is to focus on metrics that matter. Here's what Bezos has to say about this. Percentage margins are not one of the things we are seeking to optimize. It's the absolute dollar free cash flow per share that you want to maximize. And if you could do that by lowering margins, we would do that. So if you could take the free cash flow, that's something that investors can spend. Investors can't spend percentage margins. Separately, Bezos also said the following. We don't take the point of view that we're going to price products at a particular margin for ourselves. We say, we're going to price products competitively. And if that means on the product we lose money, that's okay because we need to take care of the customer and earn their trust. For investors, the way to generalize this focus on important metrics is to care about things that actually matter. Free cash flow is an excellent example where GAAP earnings is maybe not the best example in a lot of cases because it can be artificially distorted by one-time accounting charges. The sixth lesson is that we need to find ways to reduce competition by being a contrarian. Here's what Bezos says. If everything you do needs to work on a 3-year time horizon, then you're competing against a lot of people. But if you're willing to invest on a 7-year time horizon, you're now competing against a fraction of those people because very few companies are willing to do that. On a similar note, self-directed investors can find the best investment opportunities by being contrarian in nature and willing to consider stocks that most other people are ignoring, which leads to bargains. The seventh and final lesson that we'll talk about is to be frugal and recognize the time value of money. In Bezos' inaugural 1997 letter to shareholders, he wrote, "We will work hard to spend wisely and maintain our lean culture. We understand the importance of continually reinforcing a cost-conscious culture, particularly in a business incurring net losses." Frugality and being able to save more money than you earn is a key component to be able to invest in the stock market successfully over the long run. This is a principle that you can see in Bezos' management of Amazon. It's one that every self-directed investor needs to take to heart as well. Now, Throughout this entire video, we've talked about Jeff Bezos in the context of long-term thinking. And on the surface, it might not be clear why long-term thinking is so important for self-directed investors, but there's lots of reasons. The first is that it gives you greater peace of mind. When you are investing in stocks for 10 years or 20 years, you can ignore day-to-day fluctuations in stock prices that are not really indicative of what the value of the underlying business is doing. The second benefit of long-term investing is that it gives you greater tax efficiency. It allows you to defer capital gains tax and keep your money compounding in your investment account over the long run. The third benefit to long-term investing is that it encourages you to continually reinvest today's investment proceeds to compound in your account for the long run, which allows you to take the maximum advantage of compound interest. That's all we have to talk about today. I'm going to give you 3 pieces of homework before we wrap up. The first is to email me a video request at nick@suredividend.com. The second is to like this video and leave a comment saying what you thought of it. And the third is to subscribe to our channel, Sure Dividend, if you want to learn more about investing in high-quality dividend growth stocks for the long run. Thanks for watching. We'll see you next time.